have with us from Prime Focus today Mr. Namit Malhotra, Executive Chairman and Group CEO, Mr. Ramki, Managing Director, Prime Focus Limited and Founder and CEO of Prime Focus Technologies, Mr. Vikas Rathi, CFO of DNEC, and Mr. Nishant Fadia, CFO of Prime Focus Limited. We will start the conference with opening remarks from the management, after which we will open the floor for questions. I will now hand over the call to Namit for his opening remarks.
Thank you, Nitesh. Good morning, everyone, and a warm welcome. I would like to start the call with some introductory remarks and update on our creative services business, following which Ramki will brief you on the Prime Focus Technologies end, and Nishant will take you through all the financials. It has been a mixed first half of the year for us. Our top line continues to see steady growth for both the quarters, driven by our creative services business, where we are firmly established now as a global leader. Our order books continue to stay robust in both the creative services end and our technology and tech-enabled services side. However, as we continue to consolidate our global workforce to cater to the higher order books, our margins have transiently been impacted. We expect to see benefits of same to pan out in the coming quarters. Creative services reported strong growth, delivering marquee projects for the quarter like Mission Impossible, Fallout, Ant-Man, and The Wasp, among several others. With this, we have delivered work on 3 out of the top 5 global box office hits released in half year FY19. The order book continues to stay strong. Some of the Hollywood releases scheduled for coming quarters include Venom, The New Mutants, Fantastic Beasts, The Crimes of Grindelwald, etc. In India, FMS, we recently delivered work on some of the key projects such as Thugs of Hindustan. Other notable projects in the quarter include Dhadak, Satyamev Jayate, and the recent blockbuster 3, to name a few. Our pipeline remains strong with scheduled releases like Robo 2.0, Manikarnika, etc. Also, we continue to deliver new services to the leading platforms in the country and see strong visibility in future revenue potential from the segment. The general outlook for all our businesses that is creative, tech-enabled, and Indian FMS services looks rather strong. As the holiday season kicks in, we look forward to a promising second half of this financial year. I'd like to now hand over to Ramki for an update on the Prime Focus Technologies business. Ramki.
Thank you, Namit, and a very good morning to everyone. It's been a slow first half for the year for PFT, though, our order book continues to remain steady. We faced longer than expected lead time on the conversion of some of our, large RFPs in the first half of the year, especially in the international markets, which sort of have led to the decline in revenues. However, our pipeline is promising and quality of revenue remains strong. And we expect the second half to be, to be better than the first half, and that's how we see the year. The international markets contribute about 35% of our second quarter revenues, and our annuity mix is at 75%, and the product services mix is 48 to 52. Some of the other highlights of the quarter includes a partnership that we announced with Virtual AI, a leading UK-based provider of AI solutions. This is in addition to, the announcement of launch of our own native media recognition AI platform called Vision Cloud, which is actually a module within the Clear Media ERP suite. And that's sort of, interesting sort of announcements and go-to-market to leverage the use of AI within the M&E industry. And we feel quite excited with the prospects in this area, and we look forward to, making this platform work for our customers and in the next sort of ensuing quarters. We also sort of made a key organizational announcement with Mangesh Pathak, who's joined us as the Chief Strategy Officer. Mangesh Pathak was the co-founder and partner of Ambit Pragma, a private equity fund which actually led the investment within PFT in 2016 and has since been the director on the company's board. He's worked very closely with PFT in that capacity. He knows the firm, its character, and its potential as well. And we are quite happy to have him join the team, and we look forward to him working with us to develop and execute sustainable sort of corporate growth initiatives. With that, I'd like to hand over to Nishant for him to take you all through the financial highlights. Nishant?
Yes, sir. Can we begin with the question-answer session now?
Just cover the financial highlights and then we'll go to questions.
Sir, you may please proceed.
Yeah. Thanks, Ramki. Thanks, Namit.
Good morning, everyone, and thanks for taking the time to join us today. The consolidated revenue for the first half of the year increased about 15% YOY to reach 1,256 crore, and EBITDA for the same period is approximately 200 crores. This EBITDA is adjusted for non-cash ESOP charges and includes other income. More particularly, I think I'd just like to draw and clear up two items which are appearing in this quarter, which we believe are one-time and non-recurring in nature. There's a non-cash ESOP charge of about 17 crores between PFL and PFT. This is higher, and this is a charge only for this quarter. It's higher on account of extending the exercise period on these options for our employees from 2 years to 5 years. The other is a finance charge of 26 crores in this quarter. This is on account of early retirement of a financial liability we had to Macquarie at the PFW level. So that's, again, for this quarter where they've been paid off. From a business-wise performance for the first half of the year, creative services has contributed about close to 82% of our revenue, and the balance comes from our tech services and the India business. Coming to debt, the net debt position as on 30th September is about 1,969 crores. We see it a little higher because the closing in Q1 was 68.3 on the dollar, and now it's this quarter's closing is 72.33. That is in itself has an impact of about 70 to 73 crores on total debt. We also like to just point out to the community here that we've also now redeemed the second tranche of the NCDs which we had to Stanchart Private Equity in November 2018. And this sort of, and we continue to focus internally on bringing our overall leverage down and finding ways and means of doing that. I think I'll stop here and we can open the floor for questions. Thanks again for taking the time.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Before we take the next question, a reminder to the participants, if you wish to ask a question, you may press star then 1. We will take the first question from the line of Varun Advani from MB Advani and Company. Please go ahead.
Good morning, everyone. Good morning, Namit and Nishant. My question is specifically...
Excuse me, Mr. Advani, requesting you to please speak a bit louder. Your audio is not very audible.
Right. Am I audible to everyone right now?
Yes, you are. Thank you.
Great. Good morning, Namit and Nishant. My question is specifically to you, and it's a two-part question. One is regarding the debt. As Nishant mentioned, that the debt has come up to about 1,900 crores. The management has gone on record to say that they are taking conscious efforts to reduce the debt. So what action can we expect in the second half of the year, and at what level can we expect the debt at the end of this fiscal? And secondly, there was also a board resolution on the 30th of October where the management had clarified that they are taking all possible steps to monetize the subsidiaries of Prime Focus. And so I'd like to know what possible steps the management is going to be taking or possibly be taking, and what kind of value creation can we see from that effort.
Thanks, Varun. Thanks for joining us today. So on the debt side, promoter family has sort of committed to infuse about 300 crores
That's right.
into the company. So that's one of the ways of sort of addressing the leverage we have. On your question about the statement in our board meeting, I think that's more a generic statement. Across the group, whether it is PFT or PFW, we would continue to look at options to sort of bring down this leverage, whether it is any kind of sort of liquidity event. I don't want to be premature or speculative here and say that we are doing one or the other, but I think the idea was just to give confidence to the community that reducing leverage is sort of clearly one of our, priority items. And we will continue to evaluate ways and means in which we can sort of bring that down. Namit, do you want to add something to that, or?
No, I think it's fair to say that I think we had always said that as we try and build our global infrastructure in the short to medium term, there is always going to be a little creep up as far as the debt is concerned. But I think the goal is that in the short to medium term, right after we've built out our infrastructure globally, the next immediate priority would be to start accelerating and using our cash flows to pay down the debt, because that's fundamentally the direction of our strategy. And I think it's also, pertinent to say that, the team has done well in re-establishing new credit facilities, which means that even though you may see a slightly higher debt position, which is more a representation of the dollar fluctuation, but most of that debt today sits in the foreign exchange world, and actually the overall cost of that debt is actually going to be down significantly from what we had earlier. So I think going forward, there will be greater contribution to overall cash. The cost of the debt is coming down, and since we are fundamentally a Forex-led revenue and EBITDA business, I think we will see our ability to service that, basically improve as we go along. So that's sort of where I feel, we see our overall cash position and the debt position being much more in line with the expectations that we think would be sustainable for the company, and make sure that we can continue down the road of reducing that significantly over the next couple of years. I think that's all from me on this.
Right. Thanks.
So does that answer your question, Ms. Advani? Thank you. Before we take the next question, I would like to remind all participants, if you wish to ask a question, you may press star then 1. We will take the next question from the line of Salil Sharma from Kapoor Sharma & Company. Please go ahead.
Hello.
Yeah, hi Salil, go ahead.
Yeah, okay. Good morning. And I would like to continue with the earlier question. What I understood, the total debt now is 1970 crores roughly.
That's right.
Okay. Now, this is after paying back the Standard Chartered debenture, right?
This is, Standard Chartered was paid off in November, and this is the debt figure as on 30th of September. So there may be a slight variation, but it won't be significant.
And what is, how have you paid that off by adding more debt to that? So that would actually that go up to 2,400 crores?
No, the debt won't change, like I said. They've been paid out of existing facilities. So the debt won't really change much, but the quality of debt will change, because Standard Chartered was obviously a item due immediately in November. And the new facilities are obviously much longer term.
And this 26 crores, which is an extraordinary item in this quarter, this is something to do with the debenture prepayment or some other facility?
No, this is not relating to that. This is relating to a item in the PFW balance sheet. It's a liability which was due to one of our stakeholders, which has been paid. We were amortizing, we had marked that instrument at present value, and then since we decided to prepay it, we had to take the difference between present value and actual payment to P&L.
Okay, so the out of 81 crore finance cost, how much is extraordinary?
26.
Okay, that's all. 26 is extraordinary. So basically, one can expect another, the regularized figure would be around 55 crores.
Yeah, 50 to 55 crores a quarter is what we should expect as a finance cost.
But aren't we getting too leveraged we could just spin off into kind of debt traps kind of situation?
I think, clearly, like I mentioned earlier also, it is our endeavor also to leverage down, and in fact, the promoter family's initiative to put their own money in is a positive sign for us. So that should bring our leverage down a bit. But, we share your sort of view that, yes, leverage needs to be brought down, and we are trying to figure out the best way to do that.
If you put those figures together, there seems to be some kind of a problem. One, of course, is that the debt, around 200 crores earlier, we were planning to bring it down to 1,200. Now it's already...
excuse me, Mr. Sharma, I'm so sorry to interrupt. So your audio is not very audible. We are unable to hear you well. May you please use the handset mode?
No. I'm not using a handset. It's a direct call. I'll try to be more audible, yeah.
All right, thank you.
Yeah. No, my concern was that, earlier when our debt was around 1,200 crores, we were trying to bring it down. Now it's already gone up to 1,900. So it seems to be, that's a mismatch. Maybe we should have grown more with equity rather than debt.
That's one way of looking at it. And we don't rule out equity as a sort of way to address this debt. But again, yes, it is a good way, but we'll look for the most efficient way for all our stakeholders and make sure that we come up with a solution which works for everybody.
And then there was this...
Excuse me, Mr. Sharma, I'm sorry to interrupt, requesting you to please join the question queue for your follow-up as we have people waiting for their turn. Thank you. Before we take the next question, I would like to remind participants, please limit your question to 2 per participant. You may come back in the question queue if you have a follow-up, as we have people waiting for their turn. Next question is from the line of Subrato Sarkar from Mount Infra Finance. Please go ahead. Mr. Sarkar, you may please go ahead with your question.
Hello?
Yes.
Yes. My question is also in terms of debt. Last 3-4 quarters, we are continuously talking about deleveraging and all those stuff. And but nothing is happening. This quarter, apart from the currency depreciation also, there is an increase in debt itself. So we are only on a theoretical level discussing that we are looking for this opportunity and that opportunity, but as of now there is no concrete plan. So do we have some concrete, do we have some targeted numbers like EB to debt should be this in our long-term sustainable rate, or have we done some internal calculation that what should be our stable state kind of a debt figure in terms of EBITDA and all those stuff. For a few quarters now we are discussing same thing that we are planning to deleverage and all those things, but actual on ground things are just working on the opposite end. So that's still I know this is being discussed, but we are looking forward for if you can provide more your thinking in terms of specific numbers, what is your planning or what's the route you are thinking of at least?
Yeah, so I think the primary point I think we should all be cognizant of is that when we took this position of saying that we are going to be deleveraging, I don't think we ever made a statement that said every quarter that debt will come down. I think what we've said is that there is a short to medium term target of about 24 months, at which point you will see a marked reduction. And the number we have always said was between 600 to 800 crores of debt would come down in that time. But in the meanwhile, what we are making sure that we are doing is, as we continue to build the business to an optimum level, there is going to be short-term changes or movements in debt which are also driven by changes in working capital, it is driven by changes in currency depreciation, it is driven by changes in certain basic infrastructure that is being built. And what I think has to be also be considered, as I said earlier, is that you have to look at the quality of the debt. Because today we have 5-year low interest-bearing debt versus what we had 2 years ago, when we had short-term, high-interest cost Indian INR debt. So we are making significant changes in terms of the quality of the debt, profile of the debt, and the timeline that we have laid out is between 18 to 24 months to really start to see a significant deleveraging of that is happening, because that is what is the increase in our infrastructure is what is going to ultimately drive the overall margin propensity of the business to ensure that we have that kind of sustainability in the business thereafter. So this is what I would urge everybody to focus on, and not look at a quarter-on-quarter movement as an indicator of whether the debt went up or it went down. A change in forex position actually does not hurt the company in terms of where the reported debt stands. Because for us, we have let's say we had $100 million debt facility, whether the exchange rate is 65 rupees or 72 rupees. On the INR balance sheet, it looks high, but for the income and the EBITDA that is being generated against it, that is, I think, the metric that should be looked at, and what the cost at which that debt is being serviced at should be considered when we make that evaluation.
Okay. Sir, in that case, just two things. One is like, if I remove the INR depreciation and result in mark-to-market adjustment in debt, apart from that, what is the increase in debt in last 6 months? Number one. And number two, what is now our blended cost of interest, like blended cost of debt, and with hedging or without hedging?
So the blended cost of debt is about between 8 and 9%. And like I mentioned earlier in my remarks, the dollar impact on a quarter-on-quarter basis of debt is about 73 crores. So debt is higher by 73 crores on account of movement on the dollar. And yeah, I mean, is there any... Sorry, did I cover all your questions?
No, sir. So what I'm first, sir, if we have significant foreign debt, then why, sir, this blended cost is so high at 8%?
So you will appreciate that the LIBOR, US dollar LIBOR currently 6-month LIBOR is 3% itself, and then,
yes, sir.
And then banks will lend to you at a margin over that. India debt rates have gone up, and as a result of that, our blended rates are between 8 and 9.
Okay. Sir, can you please share what is the cost of India debt in that case?
We have various facilities ranging from 11 to 13 and a half.
The last question, sir.
Sarkar, I'm so sorry to interrupt, requesting you. Please join the question.
Okay.
Thank you. Next question is from the line of Alek Dalal from 130 Capital. Before that, I would like to remind participants again, please limit your question to 2 per participant. Thank you.
Hi. In terms of this comment in your presentation about IFRS 15 causing an impact in the, I guess, the second quarter, can you quantify that impact and just give some more color around what that is?
Sure. So basically, IFRS 15 is the new revenue recognition standard for this from this year onwards. What it basically says that there were some contracts which we enter which may have a net accounting impact. So when you see, strictly speaking, last year which we had, there was no impact of IFRS 15. So this quarter there is a project valued at about 40-ish crores, which otherwise would have been part of your top line, but has been shifted out to the next quarter because of the new standard. And had we booked that revenue in this quarter, the revenues would have been higher, whereas the cost for the same project continued to be booked in this quarter. So the impact, to answer your question, is about 40-ish crores on revenue, and hence whatever impact you will count on EBITDA.
Got it. So similar impact for 40 crore revenue plus EBITDA. So adjusted, and that would mostly all be in creative services, right?
That's right.
Okay, got it. So adjusted for that number, if creative services reported 78 crores in the second quarter, it would have been about 120 crores or something.
That's exactly right.
I got it. Okay. I think a lot of people have asked this question on this asset value unlocking, and seems like the thinking has been there since the last 1 or 2 quarters. Can you guide us as to whether there is some, at what stage are you in? Is this stage of contemplation or execution or advanced execution? Obviously, that's stated the 24 kind of month target, but just trying to understand sort of at what stage are we at on this.
Again, it's a little difficult to put a finger on it and say this is exactly the stage we are at. It would be, like I mentioned, premature and possibly speculative. But I think the message we are trying to get across is that we're very cognizant of this having to get done and sort of moving our, sort of channelizing senior management's efforts towards getting it done. I think I'll leave it there.
Okay. And on PFT, given sort of the year-on-year decline on EBITDA, I'm just trying to figure out, is it a revenue issue or is it a cost issue? Are you carrying too much cost and the revenues are not coming? And the delays in revenue actually delays, or these are sort of opportunities that may not come back to you? So I'm just trying to understand sort of, till what point in time do you continue to carry these costs and sort of how do you right size it? Because while the order book is good, it doesn't seem like it's translating into EBITDA.
Sure. Ramki, you want to comment?
Yeah, I think if you were to look at it, obviously we had some, obviously there is some revenue impact was on account of some order losses, which are new bids, large RFPs that we were quite hopeful of that we, in one case the decision was postponed indefinitely and the other case we lost it. And so that sort of had a revenue impact. I think the margin pressure or margin for the reduction is on account of, all these two large deals are very large tech deals, SaaS revenues. And so I think that sort of really is the mix, that the tech revenue mix had sort of gone down. And I think that, if you look at it for the first time, our tech revenues came down below 50% from a mix perspective. From constantly being 57, 58, it's down, or 55 at worst. It's now this quarter down to 48, and I think that revenue mix is really what has impacted the EBITDA this quarter.
Thank you.
Thank you. We will take the next question from the line of Pankaj Gupta from Credent Research. Please go ahead.
Yeah, good morning, sir. Sir, as you have said that we have repaid the Standard Chartered NCD debt in the month of October, November. So, sir, my question was that we have redeemed it at a premium because it was zero coupon NCD. So is it likely that in this quarter also we would have a one-time financial impact of the difference between the face value and the redemption premium?
No, it won't, because we are already taking that premium to P&L from the past few quarters, so there won't be any impact.
So in spite of being a zero coupon, we have been passing it through the P&L throughout these years.
That's right.
Correct. And second one, sir, sir, in your announcements dated 30th October, you have said two things. Hello?
Yeah, go ahead.
Yeah. In your announcements dated 30th October, you have said two things, that you are considering sale of subsidiary Genier 8 Media to DNEG. And on the same line, you are saying that the management has been authorized to explore various options and opportunities to unlock value. Sir, if you could slightly give some more color on these likely transactions and the opportunities which we are going to unlock.
I think the transaction for the sale of Generate Media is an intercompany transaction. So this company sort of does some of the back-end functions for the creative services business. And it made sense to sort of park that ownership of that business under the PFW group or the DNEG group. And so this is, it is just change of ownership within the group. It will have no impact on your consolidated financials per se, but, from the DNEG, the PFW group will sort of own all of their facilities and won't have any intercompany transactions with the parent. I think that was the whole purpose of that transaction. Again, I think earlier in the call we sort of addressed this, that rather than, a particular way or mean, I think what we are looking at is evaluating and considering and sort of working on various sort of streams of how we can unlock value across the group. And I think, that's sort of the message we are trying to pass.
Lastly, can you just guide us on the order book which we are having and the visibility of that transferring to our revenue for next year? How much growth are we expecting in top line?
I think we have about a $500 million order book between both our, all our businesses, which should pan out in the next between 24 to 48 months. The range is a little, 12 to 36 or 48 months. The reason the range is big is because the creative services business has order books, execution is over the next, let's say, from now onwards to 24. But PFT, the kind of contracts it signs are more longer term. They can be 3-year or 5-year contracts. So the blended is from now to, say, 24, 36 months.
Okay. And the last thing is that can you tell us what is the capital employed in the PFT group of business and what is the capital employed in PFW group of business?
We can send that to you offline. I don't have it ready with me right now, but I can certainly reach out to you offline and get it to you. Share the follow-up item.
Thank you, sir. Yeah. Thank you, sir. My question is over.
Thank you. We would take the next question from the line of Pradyuman Doshi, individual investor. Please go ahead.
Yeah, thanks for this opportunity, sir. I have a question for Namit.
Yeah, go ahead, Mr. Doshi.
Yeah, sir, some time ago, promoter had issued themselves warrant at rupees 106. After that, price of stock has significantly fallen. So, sir, I just have a question that would the promoters would be still exercising their warrants? Your views on that, sir?
Yes, at this point, nothing has changed in our view with regard to that. So I think that's the best thing I can say right now.
Okay. Yeah. Thank you, sir.
Thank you. Before we take the next question, a reminder to the participants, if you wish to ask a question, you may press star and 1. Next question is from the line of Salil Sharma from Kapoor Sharma & Company. Please go ahead.
Yeah, my query is regarding the employee cost, which you talked about in your presentation also. That the cost as a percentage of revenue is now 64.4 against 53.6 last year, same quarter. And you've said that this is because of Montreal. So, and we could expect a growth in revenue in the coming quarter. So, can you put some, approximately what could be that increase in revenue?
Yes, I think the way to think about it is that when we launch a new facility, it's what happens is that there's a minimum overhead. So let's say if we have a capacity of that is supposed to be for, let's say, 500 artists or 500 people. There's about 150 people that are what we would call as overhead, that is basically needed to run the facility. Currently, what you're seeing is that the revenue potential is only 1/3 of the current overhead that is carrying. The overhead right now is significantly ahead of the capacity, and that is representative of a early stage developing reality of a facility. But as soon as it starts to get to its optimal level, then those numbers and those margins automatically start to rationalize and come back in line with what is expected on a steady state basis. So, there is no reason in the short term for our overall employee costs to be going up relative to where we stand. So we believe that the ultimate, on a steady state basis, those numbers frankly will not just stabilize, but they'll actually show a downward trend as we go ahead.
So what could be the ratio then, in the coming quarters then? Say the same one?
I don't think, I have to make the request that, we don't, because, we run these big projects through the course of the year. Frankly, the quarter-to-quarter analysis is frankly not going to give you the right representation because, we could be at the end of delivering a very big project and you'll see a certain skew in a particular quarter which will not be followed in the next one. So, we try and rationalize some of these onto annual metrics and not really look at these particular skews on a quarter-on-quarter basis.
Yeah, but, okay. But, you'll also appreciate that there's been always some kind of a, one-time item each quarter. So when do you think we can expect a normalized kind of profit loss account?
Yeah, I think, again, that's a very broad statement that it's always there, or, whatever. I think the reality is that, we've only done an acquisition that started the ball rolling 4 years ago, out of which the first 12, 18 months literally meant that we had to start the integration phase. So you start with the M&A process, obviously that comes its own stage of integration, final unlocking of, the Indian cost structure and the globalization of the company, which has really transformed in the last few years. So, because it's such a wide statement, it's hard for me to give you a very specific answer. And because, there has been significant enhancement and improvement across the board, across the revenue parameters, the margin profile parameters, the quality of project delivery parameters. And what we're recognizing is that in that operating and framework, where frankly there is no other entity in the world that does what we do in terms of our current model, we are obviously ensuring that we can build up our position to operate at a certain level that is then kind of representative of what I would want to believe becomes a steady state. And I think the right time for that is about 12 to 18 months away.
Okay. Yeah. All right. Fine.
Thank you. I would like to remind participants, if you wish to ask a question, you may press star then 1 on your touchtone telephone. This is a reminder to all the participants in the conference. If you wish to ask a question, you may press star followed by 1 on your touchtone telephone. We would take the next question from the line of Salil Sharma from Kapoor Sharma and Company. Please go ahead. Mr. Sharma, I'm sorry to interrupt. We are unable to hear you, sir.
Yeah. Okay. I'm saying that I would again want to refer to the same point, saying that maybe, are we undercharging the clients or, because being a high-cost business, there seems to be some kind of mismatch that the margin also keeps varying. So is there some case like that? Are we, because of the competition, are we undercharging the clients or something of that sort?
No, I think, saying that we're undercharging the clients, I don't think there is no such precedent in our system that shows that we are undercharging, because frankly in our industry, that is not a basis on which some of the top quality projects are actually won. What we can certainly say is that the cost at which projects are being executed have their own skews from time to time, because ultimately this is it is a creative industry, so that there will be points at time, like I said, where we can have alterations in margins in projects. But I don't think there's anything out there right now that in any way signifies that to be the case. We can have a level of utilization that can change from time to time, that can cause some shift, because like I said, a project date of starting, you could have expected to have started on a project in the first week of September, and you may ended up having, there's very likelihood that instead of the project starting on September 1st week, can have started in September 3rd week. And that can impact the amount of revenue accrued in that quarter without necessarily changing your cost. However, at the point at which you deliver the project, you would have caught up, and because the delivery dates don't change, even though the start dates on projects change, and that impacts your quarter-on-quarter revenue accruing and all the consequent pieces that run with it. So that's why I'm always a bit concerned in not running this as a quarter-on-quarter reality, because those cues can be pretty confusing. We could be ending a big project in a particular quarter, and you'll have a lot of revenue in that quarter on that. And the project that's starting may show a very relatively lower capture of that, because that's just the nature in which we ultimately get to execute the work in line with the creative recommendations of our clients. And and consequently the revenue recognition that follows that percentage completion method that we follow.
Okay, and the depreciation of 70 crores, does that include any extraordinary there, or is it a regular feature?
No, that's a regular, I think, that's a regular quarterly charge. There's nothing exceptional or non-recurring in that.
So if that is our return on assets, like, there again seems to be on the higher side, isn't it? It's like the kind of assets which are required to generate this kind of turnover. Do you have any comment on that?
No, I mean, not to us. I'm not sure which metric we could use to measure that, but no, not to us.
Thank you. Well, ladies and gentlemen, that was the last question. I would now like to hand the conference over to Mr. Nishant for his closing comments.
Thanks once again, everybody, for joining us. We encourage you if there are some any more clarifications or questions you may have, please reach out to us, and we'll do the best to answer those at the earliest. And thanks to Namit, Ramki, and Vikas for joining as well. They are all in. It's extremely either late or early for them, wherever in the world they are. Thanks again.
Thank you very much, ladies and gentlemen.